We are 20 days away from finding out who will be the next president of the United States of America. How will the election results affect the price of silver? Let's find out. So to preface this video, I want to make a short disclaimer. I don't have a crystal ball. I don't know who's going to win. I don't know if Trump's going to win, if Biden's going to win. These are more my opinions on what might happen. This isn't based on any financial advice or or any deep study of how markets work. Just some things that I believe in and potentially I'm going to do. Does it matter who wins? Well, if you ask my opinion, I'll tell you it doesn't matter, right? The price of silver and assets in general will not matter depending on who wins. The stock market might jump or drop a little bit. But in the midterm, I think what will matter is how much fiscal stimulus there will be. And depending on how much fiscal stimulus is put into the economy, the price of silver will go either up or down. If you have enough fiscal stimulus, what you have is a sort of reset. That means that debts can be repaid. You inject enough money so that people in the economy can repay their debts, and the interest rates are low enough so that they feel confident that they can start spending again. And what happens is, well, people then can live. It means that suddenly they can pay back their rent debt, their education debt, household mortgages, consumer credit, all of these things. If interest rates start going down and the government starts injecting enough fiscal stimulus into the pockets of individuals, then people can start spending again. Why is this important? Well, the economy stopped. There was a shutdown. So if you shut down the economy, you're essentially, and shut down, force people to stay in. You essentially stop the economy for a certain period. And in order to get it to restart, the hardest thing is not making stuff and putting it out there or making it cheaply enough. It's to get people confident enough and feeling safe enough that they want to spend money. And if you give them money and you give them enough of it, they will start spending. It's pretty simple. So how do you fund a fiscal stimulus? Because the central bank essentially cannot just print money and drop it into your bank account. The way most fiscal stimulus works is that it has to be done through the government. The government does the fiscal spending. The central banks set the monetary policy. But for this scale of fiscal stimulus to work, the central banks need to fund the government. And the way they do it is two ways. There's two possibilities. The first one is that they helicopter drop. It means that they just print money and they give it to the government. This is unlikely because when you helicopter drop, it's irreversible. You print the money, and in the eyes of the central bank, they can never have a mechanism to reduce the monetary supply in case something goes wrong. Like they printed way too much money and they have hyperinflation. They have no method of trying to reverse the situation. You can think like, yeah, but if you do quantitative easing, you can't reverse it. Of course you can reverse quantitative easing. You set the interest rate to 25% and then suddenly everybody's buying, everybody will start saving. And then banks are like, oh, now we offer 25% interest rate. If you put your portfolio into bonds, you get 25% interest rate. People will start buying bonds. They've done it before. I think they did it in the 70s or the 80s when there was rampant inflation and they tried to reduce it. They introduced a 20% interest rate for a year, and that just killed inflation. So what will they try to do? Well, most likely they'll try to do more QE. They will try to do a huge amount of asset swaps where they swap printed money for bonds from the government. And the treasury will have their literally war chest. So these guys will have their war chest filled up. Now, what the treasury does with that money does affect to some extent the price of silver and other assets such as gold. But that's hard to predict what they will do because that depends on political will. But the more immediate effect that you will see, and I think we saw a little bit of it a few months ago when the central bank, the Federal Reserve, set the interest rate to, I think, 0.35%. And they said that they would start buying bonds to ensure that the interest rate was at 0.5%. I think most likely if they do QE, what they will do is the Treasury will issue new bonds with very low returns. For example, for $100, it will only return 35 cents or 20 cents. And the central banks will buy this. Essentially, they're giving money to the government, but they get a financial instrument that allows them to sell it and reduce money supply in case they need to actually sell it, or reduce money supply. So they will print more money and provide this money to the government through bonds. What this does, and I think there's a good video out there, I'll have to do some research, where an ex-central bank consultant was talking about what happens when the central bank decides to purchase bonds at a low price. Essentially what this does is it destroys the bond and interest market. And it just destroys the price of it. There's no, like they say, no price discovery. But people have to also remember that bonds from the Treasury, it's not really a free market vehicle, investment vehicle. This is a government investment vehicle. And essentially what you are investing in is the policy of the central bank. If you invest in, well, if bond rates drop and interest rate drop, and interest rates get completely wiped out and destroyed, what will happen is that the attractiveness of investing in in assets becomes much greater. Now you're like, yeah, so the dollar is going to tank. Maybe, but the immediate effect I can tell you is that assets of all classes become much more interesting for people who have money, right? And they want to protect their purchasing power. It becomes much, much more interesting for them. People who don't have money don't care. If you don't have money, you don't care what will happen to the interest rate because your immediate needs are fixed costs. That means that you will have to pay down rent. You will have to pay down your groceries. You'll have to pay your children's clothes. You will have to pay your taxes. You still have to pay for daily commutes to go to work if you have a job. If you don't have a job, you will have to pay for daily commutes to go to places to find a job. Or if you are a private small business owner, you will still have to pay for your daily commute to your work and then seeing your employees. These are fixed costs related to simply being alive. And I think that what will happen is the immediate effect of what will happen is that interest rate will get completely tanked. They're at 0.3%, but it can go even lower. They can get to, people are like, yeah, but their real interest rate is negative. No, we don't know what is the current inflation rate. The current inflation rate is very, very low. It's probably 1%, 2% in the United States. I know I live in a country where there currently is deflation. There's deflation because of technology. That means technologies are making goods and services more available. It's not because, people aren't spending. People are spending, but things are just getting cheaper and you have more purchasing power. It's a sign that purchasing power is greater and that because your fixed costs are going down for being alive, for example, buying groceries, healthcare, other things are becoming cheaper. But either way, these are things that you had to spend anyways. So it doesn't matter the price of these, whether these go up or down. It's better for these type of fixed costs to go down and things that you don't need, but you want to get more and more expenses over time to incentivize you to work and participate in the free economy. That's more of a philosophy thing. That's not necessarily, that's my philosophy. My philosophy is that some things should be more on a deflationary path and some things should be more on an inflationary path. More needs, it's better for needs for people, it's better to be on a deflationary path. And especially fixed costs related to being alive, like having a roof over your head and the fixed costs of having to get food, as long as these go down, it's a good sign of improved productivity. You're not going to eat 1,000,000 tomatoes and drive the price of tomatoes up through inflation. That's very unlikely to happen. Or potatoes, whatever food or vegetables you like. It's not it's not realistic, in terms of concern, unless you have population growth, which doesn't really happen so fast for humans nowadays, especially in developed economies. So to get back to the point, I'm not going to ramble on too long. In the midterm, if there is more fiscal stimulus after election, I think we can expect to see more monetary policy change to provide fiscal stimulus support. So once the government approves of a bill, right, a fiscal bill, the central bank will fund this through monetary policy. And once they do fund this through monetary policy, we'll see more interest rate drops and more cash into the system. How they will spend the fiscal stimulus, of course, that will affect the price of assets. But one thing for sure is that interest rates are just going to keep going down and tanking. I can give you a concrete example, is that I took up debt and for a mortgage, and my mortgage rate is 1% before QE. And now if I took it up, it's 0.8%. So it's a small difference. For me, the total fixed amount per month is relatively insignificant, because for the amount I take, it would be like, it's 1%. It's almost $4,000 a year for my interest rate. And yeah, is it 400? Wait, it's 1% of, yeah, it's $4,000 a year for real estate up to for what I bought. And there is no principal to be paid down for it. Fixed interest rate for 10 years. That's how low interest rates are right now. And you wonder why asset prices are going up. If I tell you that if you have access to financing and you can get that level of interest rate, it's stupid to not take it. It's just such a good deal that even if asset prices crater for the next 5 years, right? And you're like, it doesn't cost you anything. You're not at any risk. The risk is so low. If you have the ability to put up $20,000 of savings, you have free cash flow for 4 years. That's insane. That is like an insane amount of cash flow to be able to maintain your property. That's why I think in the short term, if you can take up debt, like good debt, I'm not talking about like buying a PS4 to take up debt, but if you can secure low debt, low cost, and low everything assets, either in the form of and you don't have, and there's not going to be a call on your pricing of the asset. So for example, my debt is not tied to the value of my real estate, actually. It's just tied to a monetary amount. So if you can secure a debt that purely is tied to a monetary amount, you won't get any margin calls or anything. And the interest rate is super low and you don't have to pay anything. That's probably even better than gold and silver. So what do I think will happen after the election? It will depend on the fiscal stimulus, and it doesn't really matter who wins. It will depend, and depending on how much fiscal stimulus and how the monetary policy will change, it's going to affect the price of gold and silver. How much will it change? It's a little bit of a contentious subject, because there are certain fiscal stimulus things that the government can do that will actually drop the price of gold and silver. But I don't think that it will be enough. What the monetary policy and destruction of interest rate will be more than enough to be an upward force to drive the prices of assets than whatever the fiscal stimulus governments try to put out. Because as of right now, if I look at it, there is one way the government can actually decrease the price of precious metals. And one action, it's not like they want to decrease the price of precious metals, is that they suddenly decide to provide fiscal stimulus for businesses, and they try to support zombie businesses. And this will actually fuel more or less a bubble for stocks, and it will drive the demand for dollars up. And what will happen is if the demand of dollars go up, the price of these currency metals, they tend to drop pretty fast. And I think we've seen that quite a few times. If you look at the stock market, every time there's a sell-off, the prices of metals go up, not because the stock market is tanking, but because the demand of the dollar is getting weaker. Foreign investors are not interested in holding dollars and buying American assets. That's what will drive the prices of gold and silver. That's an upward push for gold and silver. These are some of my opinions of how I think, things will turn out after the election. I don't think the election are so important for the price of gold and silver in the midterm. I don't know about long term will be like in 20, 30 years. I don't even know if these midterm expectancies will come true. I just do know that if interest rates get tanked, you're going to see assets rise like crazy. Maybe not gold and silver, maybe gold, maybe not silver, but assets will rise. So diversify a little bit and pick up some assets. Not necessarily this. You can pick up real estate. You can pick up collectibles. I don't know if I should do a video about my collectibles and how much they've gained. It's a very different market. It's a little bit of a touchy subject, but that market is crazy. So, if you like this video, if you like the content, feel free to subscribe, and I'll be doing more videos. I know this video came late because I had some work to finish up last night, so I'm posting this today, and I'll do another video before the end of the day. So you get 2 videos today. Like and subscribe, click the notification button, and thank you for watching.